There are moments in history when the destiny of an entire nation shifts beneath the feet of ordinary people who never see it coming, and November 1910 represents one of those moments for the United States of America. On a cold evening that month, 6 men boarded a private railroad car at a New Jersey station under conditions of absolute secrecy, traveling south toward a destination that would remain hidden from the American public for more than 2 decades. These weren't criminals or revolutionaries. They were among the most powerful financiers in the Western world. And what they designed during 10 days on Jekyll Island off the Georgia coast would fundamentally restructure American monetary power for the next century and beyond. Senator Nelson Aldrich, who had family connections to the Rockefeller dynasty through his daughter Abby's marriage to John D. Rockefeller Jr., led this clandestine gathering alongside it Piatt Andrew from the Treasury Department, Henry Davison representing J.P. Morgan interests, Frank Vanderlip from National City Bank with its Rockefeller associations, and Paul Verburg of Kuhn, Loeb & Company, the German-born banking expert whose family had built financial empires across Europe and America. The 6th man, Arthur Shelton, served as Aldrich's personal secretary, documenting discussions that would reshape capitalism itself. I need you to keep watching through to the very end of this documentary because what unfolds here connects directly to your economic reality today, to the purchasing power of every dollar in your wallet, and to financial crises that have repeatedly devastated American families while concentrating extraordinary wealth and power in fewer and fewer hands. And I want you to comment below where you're watching from, what city and what country, because this story belongs to people everywhere who felt the ground shift beneath their economic security. The Jekyll Island meeting did not emerge from a vacuum but from a specific crisis 3 years earlier that had brought American finance to its knees and revealed the dangerous instability of a banking system without centralized control or a lender of last resort. The Panic of 1907 began in October when a speculation scheme to corner the market on United Copper Company's stock collapsed spectacularly, triggering a crisis of confidence that spread like wildfire through New York's financial district and then across the entire nation. The Knickerbocker Trust Company, one of New York's largest financial institutions, faced devastating bank runs when depositors lined up by the thousands to withdraw their money, driven by fear that the bank would collapse and their savings would vanish into nothing. When Knickerbocker's reserves were exhausted and the institution failed on October 22, 1907, panic accelerated into a full systemic crisis that threatened to destroy the American banking system entirely. Without a central bank to provide emergency liquidity, the United States had operated without such an institution since Andrew Jackson killed the Second Bank of the United States in the 1830s. The responsibility for adjuvating the financial system fell to private bankers, specifically to J.P. Morgan, who at age 70 commanded more economic power than any individual in American history. Morgan personally orchestrated the rescue by locking New York's leading bankers in his library and refusing to let them leave until they committed tens of millions of dollars to shore up failing institutions, while John D. Rockefeller contributed massive deposits to stabilize National City Bank and other critical institutions. Morgan's intervention succeeded in stopping the immediate collapse, but the Panic of 1907 exposed a terrifying reality that America's financial stability depended on the personal wealth and willingness of a handful of extraordinarily rich men rather than on any systematic public institution designed to protect ordinary citizens and the broader economy. The aftermath of the 1907 crisis created the political environment that made Jekyll Island possible. Though the path from panic to legislation required careful political maneuvering and the suppression of public knowledge about who was actually writing America's banking laws, Congress passed the Aldrich-Vreeland Act in 1908, establishing the National Monetary Commission with Senator Aldrich as chairman, tasked with studying banking systems in Europe and proposing reforms for the United States. Aldrich spent 2 years traveling through Europe with a delegation that included Paul Warburg's brother-in-law and other banking experts, studying the operations of the Bank of England, the German Reichsbank, and the Banque de France, or centralized institutions that controlled national money supplies and served as lenders of last resort during financial stress. The European trip convinced Aldrich and his allies that America needed its own central bank, but they faced a formidable political obstacle in American populist sentiment that viewed centralized banking as a tool of Eastern financial elites designed to exploit farmers, workers, and small businesses across the heartland. Andrew Jackson's successful war against the Second Bank of the United States remained a powerful memory in American political culture, and any proposal that looked like recreating Nicholas Biddle's central bank would face fierce opposition from progressives and populists who dominated much of the Democratic Party and influenced substantial portions of the Republican base. The solution to this political problem was the strategy developed at Jekyll Island, where the attendees worked in complete secrecy for 10 days in November 1910, drafting legislation that would create a central bank in everything but name, disguising centralized control behind a facade of regional Federal Reserve banks that gave the appearance of decentralization and democratic oversight. The secrecy surrounding Jekyll Island was so complete that participants used only first names during their time together and avoided being seen as a group during the journey south, with Nelson Aldrich telling journalists that he was going on a duck hunting trip and the others traveling separately to avoid suspicion. Paul Verbe proved the most influential intellectual architect of the plan that emerged from Jekyll Island. Drawing on his deep knowledge of European central banking and his family's generations of experience in international finance stretching back to the Vorburg banking house founded in Hamburg in 1798. The Vorburg family had intermarried with the Schiff family that controlled Kuhn, Loeb & Company, one of Wall Street's most powerful investment banks that had financed much of the American railroad system and competed directly with the House of Morgan for dominance in American capital markets. This competition between Morgan interests and Rockefeller Kuhn Loeb interests represented a critical dynamic in early 20th century American finance, but at Jekyll Island, these rivals found common cause in creating a central banking system that would benefit all major financial institutions by providing elastic currency, by controlling credit conditions, and most importantly by ensuring that private banks would never again face the existential threat of catastrophic runs without a lender of last resort to provide emergency liquidity. The Aldrich plan that emerged from Jekyll Island proposed a National Reserve Association with 15 regional branches, governed by a board dominated by bankers themselves with minimal government oversight, authorized to issue currency based on commercial paper rather than gold alone, and empowered to set discount rates that would influence credit conditions throughout the American economy. When Senator Aldrich presented this plan to Congress in January 1911, he faced immediate and intense opposition from progressive Republicans and Democrats who correctly identified it as a banker-designed scheme that would privatize control over the nation's money supply while socializing the risks and costs of financial system failures. William Jennings Bryan, the populist leader who had run for president 3 times on platforms that included attacks on Eastern financial interests and gold standard orthodoxy, denounced the Aldrich plan as exactly the kind of centralized money trust that threatened American democracy and economic independence. The 1910 congressional elections that gave Democrats control of the House of Representatives, followed by Woodrow Wilson's capture of the presidency in 1912, appeared to kill any chance that the Aldrich plan would become law, but appearances deceived because the essential architecture developed at Jekyll Island survived the political transition. Representative Carter Glass of Virginia, who became chairman of the House Banking Committee, worked with Wilson administration officials to redraft the legislation as the Federal Reserve Act, removing Senator Aldrich's name and making modifications designed to give the appearance of government control through a presidentially appointed Federal Reserve Board while preserving the decentralized structure of regional reserve banks and maintaining substantial banker influence through advisory committees and member bank ownership of Federal Reserve stock. The political genius of this reformulation was that it allowed Democrats to claim they were creating a government institution to check Wall Street power, while the actual operational structure gave the banking community extraordinary influence over monetary policy, credit allocation, and the terms on which Federal Reserve banks would provide liquidity to member institutions during periods of financial stress. The Federal Reserve Act passed Congress on December 22, 1913, with overwhelming support after months of debate that focused public attention on superficial questions about government versus private control, while the fundamental questions about who would benefit from centralized monetary authority received far less scrutiny. President Wilson signed the legislation into law on December 23, 1913, creating the Federal Reserve System that began operations in November 1914, just months after World War I erupted in Europe and transformed global finance in ways that would prove extraordinarily profitable for American banks with Federal Reserve backing. The timing proved almost too perfect just as Europe's great powers began spending unprecedented sums on industrial warfare. The United States gained a central bank capable of expanding currency and credit to finance the war bonds that would transfer billions of dollars from European governments to American financial institutions. J.P. Morgan and Company became the primary American agent for British and French war purchasing, handling transactions worth billions of dollars and earning commissions that enriched the bank beyond anything previously imaginable in peacetime commerce, while National City Bank and other Rockefeller-associated institutions expanded their international operations dramatically by financing American exports to the Allied powers. The Federal Reserve facilitated this expansion by creating an elastic currency that could grow to accommodate wartime credit demands without the rigid constraints that had characterized the old national banking system tied directly to gold reserves and treasury bond holdings. When the United States entered World War I in April 1917, the Federal Reserve became the primary mechanism through which the government financed American military mobilization, orchestrating massive Liberty Loan campaigns that sold war bonds to millions of Americans while using its discount window to ensure that banks had the liquidity needed to support this unprecedented expansion of government debt. The families and institutions that had gathered at Jekyll Island 7 years earlier found themselves at the center. of this massive financial transformation, serving on Federal Reserve boards, managing war bond operations, and positioning their banks to benefit from the fundamental restructuring of global finance that occurred between 1914 and 1918. Benjamin Strong, who had been a key lieutenant in J.P. Morgan's firm during the 1907 panic and had participated in Morgan's library meeting that stabilized the banking system, became the first governor of the Federal Reserve Bank of New York, by far the most powerful position in the entire Federal Reserve System because New York served as the center of American finance and the primary connection point between American banking and European capital markets. Strong's two-decade tenure running the New York Fed gave him extraordinary influence over American monetary policy, influence that he used in close coordination with the same banking interests that had designed the system in the first place, creating a revolving door between private banking and Federal Reserve leadership that would become a permanent feature of American financial governance. The immediate post-war years brought inflation, recession, and agricultural depression that devastated American farmers who had borrowed heavily to expand production during wartime only to face collapsing commodity prices when European agriculture resumed after 1918. But for the major financial institutions connected to the Federal Reserve System, these years brought unprecedented growth in assets, influence, and international reach. The 1920s roared not just for speakeasy patrons and stock speculators, but for the banking dynasties that had created the Federal Reserve, as American capital flooded into European reconstruction loans, Latin American development projects, and domestic stock market speculation facilitated by easy credit conditions and minimal regulatory oversight. The House of Morgan reached the peak of its power during the 1920s, with J.P. Morgan and Company serving almost as a private central bank for the entire Western world, arranging loans for European governments, stabilizing currencies, and working so closely with the Federal Reserve and the Treasury Department that the line between public authority and private interest became nearly invisible. The Rockefeller financial empire expanded even more dramatically, with National City Bank growing into the largest financial institution in the United States and pioneering the creation of foreign branches that would establish a global banking presence. Paul Volcker, the architect of the Federal Reserve System, served on the Federal Reserve Board until 1918 and then returned to private banking, watching with satisfaction as the institution he had designed performed exactly as intended, providing elastic currency, controlling credit conditions, and ensuring that major banks had access to liquidity during periodic stress, while smaller institutions without such access faced greater vulnerability to runs and failures. The spectacular collapse that began on Black Thursday, October 24, 1929, and accelerated into Black Tuesday 4 days later, did not emerge from nowhere but from specific monetary policy decisions made by the Federal Reserve System that had been operating for just 15 years and was still learning how to wield the extraordinary power it possessed over American credit conditions and currency supply. Throughout 1928 and into 1929, Federal Reserve officials became increasingly concerned about what they perceived as excessive speculation in the stock market, where share prices had risen to levels that appeared disconnected from underlying corporate earnings and where margin buying allowed investors to control large stock positions, with borrowed money that amplified both gains and potential losses. The Federal Reserve Bank of New York under Benjamin Strong's leadership had maintained relatively accommodative monetary policy through most of the 1920s, but Strong died in October 1928, removing the most experienced and skilled monetary policymaker from the system at a critical moment. His successors at the New York Fed and on the Federal Reserve Board in Washington decided to raise interest rates aggressively to cool stock market speculation, increasing the discount rate from 3.5% in early 1928 to 6% by August 1929, a level that represented extraordinarily tight money in an economy experiencing virtually no inflation and indeed experiencing some deflationary pressure in commodity prices. This tight money policy succeeded in its immediate objective. It helped trigger the stock market crash, but the Federal Reserve then failed catastrophically in its response to the banking panics that followed, allowing the money supply to contract by nearly 30% between 1930 and 1933 in what economists Milton Friedman and Anna Schwartz would later identify as the Federal Reserve's greatest policy failure, transforming what should have been a manageable recession into the worst economic catastrophe in American history. The banking panics that swept across America between 1930 and 1933 destroyed thousands of financial institutions and wiped out the life savings of millions of families who had trusted their local banks to safeguard deposits that had no federal insurance and no guarantee beyond the bank's own reserves and assets. When depositors lost confidence in a bank's stability, rational fear drove them to withdraw their money immediately. But because banks operated on fractional reserve principles, keeping only a portion of deposits as cash reserves while lending out the rest, even healthy banks could not survive if enough depositors demanded their money simultaneously. The Federal Reserve System had been created specifically to prevent such panics by serving as a lender of last resort that could provide emergency liquidity to solvent banks facing temporary runs. But during the critical years from 1930 to 1933, the Fed failed to perform this function adequately, instead allowing bank failures to cascade through the system and destroy the money supply that existed, primarily as bank deposits rather than physical currency. The largest and most devastating wave of bank failures occurred in late 1930 when the Bank of United States in New York collapsed in December, taking down $200 million in deposits, the largest bank failure in American history to that point and triggering panic that spread nationwide. The Bank of United States served primarily immigrant and working-class depositors rather than the wealthy elite, and some historians have suggested that the New York banking establishment, dominated by firms like J.P. Morgan and National City Bank, showed insufficient urgency in rescuing an institution that served customers outside their traditional networks, allowing it to fail when a coordinated rescue might have been possible and might have prevented the broader panic that followed. As the Depression deepened through 1931 and 1932, unemployment reached 25%, industrial production collapsed by nearly half, and agricultural prices fell so catastrophically that farmers in the Midwest burned corn for fuel because it was cheaper than coal, while simultaneously millions of urban Americans went hungry because they could not afford to buy food at any price. The wealth of destruction was extraordinary and widely distributed. Stock values declined by 89% from their 1929 peaks, wiping out not just speculators but also prudent investors who had accumulated modest portfolios for retirement, while real estate values plummeted as foreclosures created massive oversupply and destroyed home equity that represented most families' primary asset. Yet even as this destruction occurred, certain patterns emerged that would repeat in future crises. The largest and best-connected financial institutions survived while smaller regional banks failed by the thousands. Concentration of financial power increased as stronger institutions absorbed failed competitors at distressed prices, and the families whose representatives had gathered at Jekyll Island 2 decades earlier saw their relative positions strengthen even as absolute wealth declined. TEMPORARILY J.P. Morgan & Company weathered the Depression without requiring government assistance, maintaining its position as America's most prestigious investment bank and actually expanding its influence over corporate America as desperate companies sought Morgan financing and accepted Morgan representatives on their boards of directors as the price of survival. The Rockefeller family, though affected by the stock market collapse like all major investors, had diversified so extensively into real estate, oil production, and direct industrial ownership that they maintained enormous wealth throughout the Depression and used the crisis to acquire valuable assets at fire sale prices. Rockefeller Center, the massive Manhattan real estate development, was constructed during the depths of the Depression as a demonstration of the family's continued financial power and confidence in eventual recovery. The political response to the Depression brought Franklin Roosevelt to power in 1933 with an overwhelming mandate for change and produced the New Deal legislation that fundamentally restructured American capitalism. Yet the actual implementation of reform preserved and even strengthened the essential power of the Federal Reserve System and the major financial institutions that dominated American banking. Roosevelt's first action as president was declaring a nationwide bank holiday on March 6, 1933. Closing every bank in America for inspection and reopening only those deemed sound enough to survive a dramatic assertion of government authority that stabilized the banking system but also accelerated consolidation by eliminating weaker competitors and strengthening the major institutions that passed inspection and received depositor confidence. The Glass-Steagall Act of 1933 separated commercial banking from investment banking, forcing institutions to choose between accepting deposits and underwriting securities, which appeared to be a major reform limiting Wall Street power but in practice created protected oligopolies in both sectors. J.P. Morgan chose commercial banking and spun off Morgan Stanley as an investment bank, effectively creating two powerful institutions from one, while other major banks made similar choices that preserved their dominance in their chosen sectors. The Federal Deposit Insurance Corporation, created by Glass-Steagall, provided government guarantees for bank deposits up to $2,500, which restored public confidence in the banking system but also created moral hazard by allowing banks to take risks with deposits that taxpayers would ultimately guarantee, socializing losses while privatizing profits. The Banking Act of 1935 restructured the Federal Reserve System to concentrate more power in Washington with the Board of Governors while reducing the autonomy of regional Federal Reserve banks, particularly New York, but this centralization still left substantial influence for the banking industry through the Federal Advisory Council and through the ownership structure that gave member banks stock in their regional Federal Reserve banks. If you're finding this information valuable and you want to understand how these historical patterns connect to your economic reality today, please take a moment to like this video, subscribe to the channel, and hit that notification bell so you never miss content that helps you understand the financial forces shaping your life, and comment below telling me where you're watching from, what city and what country, because this story connects people everywhere who've been affected by these recurring crises. World War II and its aftermath brought unprecedented prosperity to America and extraordinary profits to the financial institutions that financed industrial mobilization and post-war reconstruction. But it also created the Bretton Woods system that would eventually produce the next major crisis in American monetary policy when structural tensions became unsustainable 3 decades later. The Bretton Woods Agreement, negotiated in July 1944, established a new international monetary order with the US dollar serving as the world's reserve currency, convertible to gold at $35 per ounce, while other major currencies maintained fixed exchange rates to the dollar and threw it to gold. This system worked magnificently for 2 decades because America emerged from World War II with 2/3 of the world's gold reserves, an industrial base that produced half of global manufacturing output, and creditor status that made the dollar the most trusted currency on earth. American banks, particularly those with existing international operations like National City Bank, Chase Manhattan Bank, formed by the Rockefeller family's merger of Chase National and Bank of Manhattan, and Morgan Guaranty Trust, expanded globally during the 1950s and 1960s, financing European reconstruction through the Marshall Plan, backing American corporate expansion into foreign markets, and developing new financial instruments like Eurodollar deposits that allowed dollars to circulate internationally outside US regulatory control. Yet the Bretton Woods system contained a fundamental contradiction, identified by economist Robert Triffin in 1962, provide sufficient dollars for global trade and reserves. The United States needed to run balance of payments deficits, but those persistent deficits would eventually undermine confidence in dollar convertibility to gold at the fixed $35 price, creating the conditions for crisis. The crisis materialized in August 1971 when President Richard Nixon announced the closure of the gold window, ending dollar convertibility to gold and effectively destroying the Bretton Woods system that had structured international finance for a quarter century. The immediate trigger was a request from Britain on August 11, 1971, to convert $3 billion in dollar reserves to gold, a demand that would have severely depleted American gold stocks and likely triggered similar requests from other nations that would have exhausted Fort Knox entirely. Nixon acted on advice from Treasury Secretary John Connally and Federal Reserve Chairman Arthur Burns, who recognized that maintaining gold convertibility at $35 per ounce had become impossible given persistent U.S. trade deficits driven by Vietnam War spending, Great Society domestic programs, and the rising competitiveness of rebuilt German and Japanese industries that were capturing global market share from American manufacturers. The Nixon shock of August 15, 1971, combined dollar inconvertibility with wage and price controls and an import surcharge, presenting these radical changes as necessary to protect American workers and maintain economic stability. But the deeper truth was that Nixon's decision represented the final abandonment of any commodity backing for the dollar and the complete transition to a pure fiat currency system where money's value rested solely on government decree and public confidence rather than on any tangible asset. This transformation had profound implications that would unfold over subsequent decades. It removed all constraints on money creation by the Federal Reserve. It enabled unprecedented expansion of government debt that could be financed by simply printing more dollars. And it created the conditions for financialization where wealth increasingly came from manipulating money and credit rather than from producing real goods and services. The decade following the Nixon shock brought stagflation that combined rising unemployment with accelerating inflation. An economic nightmare that Keynesian theory had declared impossible, but that devastated American workers who saw their real wages stagnate while the purchasing power of their savings eroded through inflation that reached double digits by 1979. Federal Reserve Chairman Paul Volcker, appointed by President Carter in August 1979, broke the back of inflation through draconian monetary tightening that raised the federal funds rate above 20% in 1981, deliberately inducing the deepest recession since the Great Depression to squeeze inflation out of the economy regardless of the unemployment and business failures that this policy produced. The Volcker recession worked inflation fell from nearly 15% in 1982 below 4% by 1983, but the cost was borne primarily by industrial workers whose factories closed permanently, by farmers who faced foreclosure as land values collapsed, and by developing nations that had borrowed heavily in dollars and found themselves unable to service debts when interest rates quintupled. The major banks that had lent aggressively to Latin American governments during the 1970s when petrodollars recycled through New York needed investment opportunities faced potential insolvency when Mexico, Brazil, Argentina, and other debtors threatened default in 1982. But the Federal Reserve and Treasury Department orchestrated rescues that protected bank balance sheets while imposing austerity on debtor nations through International Monetary Fund structural adjustment programs that prioritized debt service over social spending. The financial deregulation that accelerated under Reagan's administration from 1981 onward systematically dismantled Depression-era protections and enabled the creation of new risks that would eventually produce the 2008 crisis. Yet at each stage, this deregulation was promoted by and benefited the largest financial institutions whose growing political influence shaped legislation and regulatory interpretation. The Sarbanes-St. Germain Act of 1982 loosened restrictions on savings and loan institutions, allowing them to make risky commercial loans and investments that previously had been prohibited, creating the conditions for the S&L crisis later that decade that would cost taxpayers over $100 billion, when more than 1,000 institutions failed and required government rescue. The pattern became familiar. Deregulation enabled speculation and fraud. Crisis followed inevitably, and taxpayer-funded bailouts protected depositors and major creditors, while institution operators who had taken the risks often escaped with their wealth intact or received only minor penalties relative to the damage they caused. Throughout the 1990s, Wall Street lobbied intensively for further deregulation, culminating in the Gramm-Leach-Bliley Act of 1999 that repealed Glass-Steagall's separation between commercial and investment banking, allowing the creation of massive financial supermarkets like Citigroup that combined deposit-taking, securities underwriting, insurance operations, and proprietary trading under one roof, concentrating risk and creating institutions so large and interconnected that their failure would threaten the entire system, the too-big-to-fail problem that would define the 2008 crisis response.